Forget GPUs for a minute. A so-called boring hard drive company just cranked out almost $1 billion in free cash flow in 90 days, all by hoarding data for AI agents. Welcome to Earnings Unscripted. It is Tuesday, April 28th, 2026, and we are unpacking Seagate Technology, that is ticker STX, their fiscal Q3. And honestly, it is kind of a wild report.
Yeah, kind of is an understatement. Look, the market was clearly asleep on this one. The stock actually closed regular trading a bit weak, around 579, and then it just immediately spiked vertically, up over 15% after hours. I think it hit almost 687 at one point. They are basically sold out of data center capacity through the end of calendar 2027.
Sold out through 2027. That is just insane. Quick reminder before we get completely derailed here. This is just our personal opinion and definitely not financial advice. But Miro, Seagate makes physical magnetic hard drives like spinning disks. Why is AI suddenly buying up the entire global supply of old school storage?
Right. Well, because the narrative is completely shifting. We know training AI takes fast memory, but the CEO flagged this massive transition to Agentic AI. So an autonomous agent does not just sit there waiting for a prompt. It runs these continuous background loops, it reasons, and it generates massive, durable outputs. That data needs a permanent home. On top of that, if you look at the top 3 cloud providers, their remaining performance obligations nearly doubled to over $1 trillion. All of that future cloud compute essentially guarantees they're going to need cheap, scalable storage on the back end.
Okay, that actually makes so much sense. The CEO gave this anecdote on the call that really made it click for me. A single autonomous car apparently generates up to 4 terabytes of sensor data every single hour, and car makers have to keep that data for 10 years just for regulatory reasons. You literally have to put that somewhere cheap.
Exactly. You need mass capacity nearline drives. That is the entire core of Seagate's business right now. And when you look at the financials, you just see the pricing leverage from being sold out playing out in real time. I mean, revenue came in at $3.11 billion, which is up 10% sequentially. But the real story is profitability. Their non-GAAP operating margin hit 37.5%. That's a massive 560 basis points expansion quarter over quarter. Just pure pricing power at work.
That 560 basis points is a huge jump, and they reported EPS of $4.10, which is a 32% jump from last quarter. But circling back to that cash flow, they didn't just sit on that $953 million, right?
No, they were completely ruthless with it. They took that free cash and wiped out over $600 million in exchangeable debt that was due in 2028. Because their stock price ran up so fast this year, that debt was about to hit its conversion price and severely dilute existing shareholders. So they just bought it out in cash. It's a masterclass in capital defense.
I love that. $1 billion defensive maneuver. All right, let's get into the details on how they're actually managing this capacity ceiling.
Well, the funny thing is, they actually are not expanding physical capacity. I mean, they are barely making any more individual hard drives than they used to.
Wait, back up. Revenue is up over 40% year over year. How are unit shipments not moving?
Because of areal density. It is entirely about cramming more data onto the exact same physical disk using their new HAMR laser tech. Dave Mosley and Gianluca Romano were both very clear about this. Gianluca basically told an analyst that they are still not growing units, and frankly, I am quoting here, otherwise the units will actually go down. So all of this top-line growth is purely because the cloud guys are migrating to the newer 40 terabyte drives instead of the older 30 terabyte models.
Okay, so they're shipping roughly the exact same number of boxes, just putting significantly denser magic inside them and charging way more for it. Which, honestly, sounds like a dream scenario for margins.
Right, except it forces a pretty brutal strategic trade-off. Since their wafer fab is completely full building these massive mosaic drives for the hyperscalers, they are quietly starving the lower end of their market.
What do you mean by starving the lower end, like the edge devices and enterprise networks?
Exactly. So previously, management made a pretty big deal about releasing a 20 terabyte Mosaic drive, something highly efficient to target edge IoT and legacy enterprise stuff. But on this call, Gianluca essentially said they're shelving that. He admitted the demand is so strong in the public cloud that, and this is practically verbatim, they just don't have enough volume to implement the lower capacity strategy.
Geez, that is a massive pivot. I mean, you're basically telling an entire customer segment they have to wait at the back of the line because you're too busy serving Amazon and Microsoft?
It is arrogant, maybe, but mathematically, it makes total sense. Why waste valuable factory time printing a 20 terabyte drive when you can print a 40 terabyte drive, sell it instantly to a cloud provider, and lock in a 37% operating margin? It's ruthless prioritization.
Sure, I get the math, but I don't know, Miro, isn't that inherently risky? If you intentionally abandon the edge market because you are capacity constrained, you are inviting SSDs to permanently capture those customers. You are effectively burning a bridge you might need if the AI cloud demand ever normalizes.
I think they would argue the bridge is already on fire and they're just running to the safe side. Look, they know flash memory is eating the lower capacity tiers eventually. But here's the thing that really stood out to me from a structural perspective. By completely locking on to these premium build-to-order contracts, they are freezing their costs. They are guiding for operating expenses to be essentially flat, around $295 million a quarter on a pure dollar basis, not as a percentage of revenue. Flat dollars.
Oh, wow. Okay, yes, that is huge, because if OpEx doesn't budge at all, every single incremental dollar they squeeze out of those big cloud agreements drops directly to the bottom line.
Exactly. It is maximum leverage. They are running a thermal budget at redline, basically. The vulnerability only comes if their technology hits a physics wall. Say the leap to the next 50 terabyte Mosaic drive gets delayed. Without actual unit volume growth to fall back on, their revenue would violently stall.
Right, because you literally cannot just push more units out the door to make up the difference. Your factories are already maxed out through 2027.
Spot on. It is a brilliant strategy for right now, but they are absolutely walking a tightrope on execution.
Well, that kind of extreme capital discipline is exactly what Wall Street loves to see, even if it comes with strings attached. And clearly Fitch agrees, considering they just rewarded that cash flow surge by upgrading Seagate's bet to investment grade. So where does this actually leave them heading into their fiscal fourth quarter?
It leaves them projecting some pretty aggressive numbers. They are actually guiding for $3.45 billion in revenue next quarter. And non-GAAP earnings at $5 a share.
$5. So that is what, like a 40% year-over-year revenue jump?
Roughly, 41%, yeah. And because they committed to keeping operating expenses totally flat, management expects operating margins to push into the low 40% range.
Okay. That is just wild for a legacy hardware company. Dave Mosige actually said they are entering a period of structural growth. But, I mean, it feels like they are hanging this entire outlook on those long-term supply agreements.
They are. The entire strategy rests on it.
Right. So what happens if one major cloud provider changes their architecture? Like they suddenly decide to rely more on flash arrays and try to back out of an order. Is this whole margin story just fragile?
That is the exact vulnerability to watch. You hit it. But Gianluca Romano went out of his way to say they are confident in growing profit sequentially through all of fiscal 2027. You really don't make a four-quarter promise like that publicly unless those cloud contracts are basically ironclad.
Right, like locked in stone, no walkbacks allowed. It is just fascinating to watch a company everyone assumed was a commodity dinosaur completely dictate terms to big tech.
The leverage has completely inverted. So going forward, it sounds like the main thing to watch is not really market demand at all. It's just whether their physics team can keep hitting the areal density targets.
Exactly. The physics has to deliver on schedule. Because if the next jump to 50 terabytes gets delayed and they're still out of physical factory capacity, the top line growth just stops. They have no plan B for volume.
Wow. It really is all about cramming more into the exact same box. Well, they are executing beautifully right now, and you kind of have to respect the discipline. I think that's a great place to leave it for today.
Yeah, I think so too. Good spot to wrap up.
All right, everyone. Thanks for joining us to talk about the surprisingly profitable revival of spinning Rust. See you after the next earnings call.
Catch you next time.
If you want these earnings wraps to just automatically show up for you, feel free to give the show a follow. And as a quick aside, this podcast is actually built with the help of AI, turning dry financial filings into a fluid conversational story. We would love your feedback, so if there's a specific ticker you would like us to unpack next, just drop us a line at earningsunscripted@datamadness.ca or check the show notes for our X link.
We actually do read them.